Hi everyone, good morning. And this morning I'm going to talk to you about the compliance sales process. I know a lot of you have got your role plays now scheduled with the Primus ASM. So of course it's a time where you sit down and think, role play, what am I going to do? How's it structured? And more importantly, what am I going to do? Where do I start? So what we've done, we've put together a case study. Now I spoke to one of the ASMs at Primus yesterday. She's given me an old case study, which we have now revised ourselves internally at Fortune Financial. And we've put together a illustration for the mortgage and an illustration based on the requirements of protecting the mortgage and the individual for the debt and also for his income. So I'm going to share screen with you. I'm going to fly through this. By all means, watch it over and over and, pick out the bits that, feel are most relevant. I will slightly go over the top. When you do your role play, it's not expected that you do it from a competency status. You're going to pass with what's called competency with development needs naturally, especially if you're a trainee. If you're a CAS advisor and you're watching this, and of course, I'd expect you to follow the sales process from start to finish and understand that, you've got to tick every box. So coming on to the case study, I'm just going to share a screen with you. So you'll have received the case study via email. If you've not got it yet, reach out to me and I'll get it sent over to you. And the case study is named Mr. Howard Whale. Don't ask me why, but we'll just run with it. So his details are there, date of birth, is he a smoker, is he not? That's relevant for protection. Existing address. Now, this guy is a first-time buyer. For you, that enables the case study to be fairly straightforward. We're not reviewing existing mortgage circumstances. The guy's not got any protection in place at the moment. So really, it's a blank canvas of a client that needs a new mortgage to purchase a property and wants to ensure that he's fully protected for the borrowings. Now, he doesn't have dependents and he doesn't have a partner. So the priority for him is himself. And that will be critical illness cover to cover the mortgage debt and also income protection, because naturally his income is what's going to be paying for the mortgage moving forward. So this case study is just going to give you a brief overview of the client itself and his circumstance. So I suppose what you're looking at here is a completed fact find. So as you can see, client details at the top, residential status, first-time buyer, offer accepted at 160,000. This chap is an accountant. He earns 36,500 per annum, and his net income is just over £2,000, 2,095. Now, something really important to note there: he's got 3 months full pay and no half pay. So his employer is going to pay him for 3 months. He's unable to work due to accident and sickness. And you've got 3 months pay slips for him as well. So by means of the mortgage, of course, we can assess his affordability on that basis when it comes to making the offering in real life terms. Now, expenditure, of course, that's really important. We want to make sure he's not got overly excessive liabilities. And of course, when you do assess a client's needs in the real world, you're going to look at their income, you're going to look at their expenditure, and it's going to leave an amount of money left over that they can then contribute towards the mortgage, the protection, the home insurance, or whatever else they'll be looking to take out. And of course, as an advisor, you need to be able to kind of prove that the affordability is there for your customers as well. So his current liabilities, he does have a credit card, personal loan. That will be factored in with the mortgage. Again, for the role play, it's not something we need to discuss. And then it talks about the property in itself. So the purchase of the property is at 160, and he's a first-time buyer, standard property, mortgage required, 140,000 over 25 years on a repayment basis. So again, fact-find information, credit history, what his requirements are. He's going to retire at 68. That's really important because you can't take a mortgage term then beyond 68 because he wouldn't be able to afford it, I'm sure, unless he's got some kind of amazing pension that we'd all want. And then also with the protection, if you're going to do income protection, which I believe that's what we're going to move on to for this recommendation through the case study, if he's protected income, then his income's going to end at 68 because he's retiring. That's when the income protection policy will end naturally, because if he's seen to be financially stable and ending work, then naturally doesn't need that income protection policy anymore. So that will run up until the age of 68. So it's important the mortgage is repaid in full by the end of the term. he wants a repayment mortgage, capital and interest. And as a first-time buyer, you're going to find that the loan to value, the loan against the property value is going to be a high one. He's going to have a small deposit. So you won't be able to get him an interest-only mortgage in this current climate and the current times anyway. So it's a full repayment mortgage. And he's got a few features, a few requirements. He wants a 5-year fixed. That means he wants some security with his payments for the next 5 years. And he wants to be able to overpay by 10%. He doesn't want an ERC overhang, which means early repayment charge, which means, of course, when you take a fixed product, let's say a 5-year, like this example, throughout that 5-year period, to leave the lender, it's likely that they're going to get a charge within that period because you're signing up for a 5-year fixed deal. They want to tie you in. They want to guarantee their interest. But if you do want to move early, you can, but you're going to have to pay the early repayment charge, which we'll come on to within the illustration. So there's no protection in place, and he's not concerned about death. I mentioned that earlier. No children. So, his priority is him. So he wants some critical illness cover and he needs income protection. Good news is he's of good health, no material facts that should, be disclosed, which, by means of sourcing, then you can source based on the best requirements. And he's already said regards to the home insurance, bills and contents, he's going to do it himself online. But as a business, of course, we'd always encourage to get a second opinion through our home insurance hub. Now, he's not interested in redundancy cover as he feels the employment is pretty secure. So his budget, once again, needs to go towards critical illness cover and income protection. Okay, so I'm just going to stop that. You have a look at that in your own time, understand the case study. I think that's the key to be able to go into your role plays, understanding, what your client's about. And in the real world, again, with a customer, you want to make sure that you fully understand their situation. So then when you do make a recommendation, it's tailored specifically for their needs as well. Now, the role play itself will be made up of a first appointment and a second appointment. Now, you'll have seen my initial video on the Facebook group and also on the WhatsApp chat. That's regards to your initial disclosure document. I'm not going to touch on that this morning. Look at the previous video. It'll be exactly the same as I did. So the first appointment is sitting down with the customer, introducing yourself through your initial disclosure document, and it does exactly what it says on the tin, initial disclosure. It's the first thing you do within the role play. So you present your initial disclosure, your business card if you've got one. If you've not, of course, you can pass your details in a digital format. It's 2022 at the end of the day. And then also you're going to complete a fact find. Now, within the role play, we don't complete a fact find. The fact find is done for you through the case study. So the good news is that you can be familiar with that now going into the role play as well. Now, it's important to look at the observation form that your ASM's provided to you to see the key areas that they want you to cover within the first appointment. But really, it is a matter of explaining your initial disclosure, data protection, regards to the privacy notice. Touch on that, don't read through it. All that means is how long and how we handle your client's data. It's for them to read, short and sweet. Message to say that's included within the initial disclosure. And then you move on to the fact find, which is, establishing the need for the customer. So that's been done for you. So the priority of today and this morning is to talk about the sales process and the recommendation. So let's jump straight in. If you're going into mortgages and not protection, you're going to be presenting to start with your mortgage illustration. So hopefully you can see that on the screen. Now, this is based on the case study. I did this and refreshed it for you yesterday. And I'm just going to run through this exactly as I will with a customer and exactly as you will do for a role play with your ASM at Primus. So let's get going. Your mortgage illustration. It's a document produced on the 16th of the 3rd. It's for you, Mr. Howard Whale. And what you can see is that I've chose the lender HSBC, and the reasons around that is what I'm going to come on to throughout the illustration. Now, before we get going, I want you to know that, we are Fortune Financial. Just reconfirm that from our initial appointment. I'm Mark Seddon. If you do need to contact me, my contact number is here. How we get paid for the mortgage is that we get paid in two ways. We get paid from the lender for doing a job on their behalf. There's some information within this box here with regards to how ourselves and Primus get paid. And then we also charge broker fees, which are based on a case-to-case basis. And again, that's something that I am going to come on to. So exactly what you want to know is, what's the product and what that's going to do for you. Now, I can see you're a first-time buyer. So I'm recommending a first-time buyer 5-year fixed rate. And I know your preferences were to reduce the fees up front. So we've actually gone with a fee-free product. The reason for this is that this is the most cost-effective product over a 5-year period, with the total to pay in based on interest, payments, any costs involved, and including, of course, that interest I just mentioned as well, which is really important. Now, the loan is for 140,000, as you can see below, and that's due to your current deposit we've discussed, and it will be taken over a 25-year period, which will reflect in your monthly payments, being interest and capital mortgage, known as a repayment mortgage. Essentially what that means is that your balance will decrease month in, month out, year in, year out, and at the end of the term of the mortgage, we'll look to have your mortgage paid off and the property will be yours. So what is disclosed here is that currently, based on this assessment of this illustration, for every pound you borrow, you're paying back 1.48, so £1.48. So it's a product at 90% loan to value. So the deposit you put in is 20,000. So the maximum theoretically possible to borrow will be 144,000 based at 90%. So why I'm highlighting that is that the valuation at 160 needs to stack up when the lender does their valuation to move forward to a mortgage offer for you. So you've got some slight flexibility with that, but I think we're confident because your offer's been accepted at 160,000 that will be the case. Now, of course, the loan, it will be secured against the property as first charge, and that gives the lender, HSBC, some security as well. Now, I'm going to talk to you about the actual fixed rate itself. The fixed rate is fixed for 5 years, as I say. It's 2.54% up until the 31st of the 7th, 2027. The HSB standard variable rate is currently 3.79%. Now, what I would say with that is it's slightly a mystical rate because that can change at any time. It's controlled by the lender. Now, the purpose of a fixed rate product is that come the end of that product, you will revert to a standard variable rate. But that said, what we do as a service for you, we contact you about 6 to 7 months prior to your deal ending. And that enables you to look towards a remortgage, whether that's a product transfer with your existing lender, HSBC, or alternatively look at the whole of market and of course look at your circumstances at the time to see how they've changed and how they can be reflected in a new offering for you. Now, the annual percentage rate of charge is the total cost of the loan expressed as an annual percentage. So the APRC is provided to help you compare different offers. What I can say to you, and I'll put a comparison report together for you to express and show you this today, is that this is the best product for you by means of the most cost effective over a 5-year period and the total amount you were paying in that time. So there's no costs involved by means of the lender. It's got a free valuation, and legal costs, of course, we'll discuss separately, but our broker application fee is paid when the mortgage completes, and that's £500 and that's non-refundable. So you'll just notice at the bottom here, it says this APR is calculated using assumptions regarding the interest rate. So the interest rate and the standard variable with the lender, as I previously mentioned, can change anytime. Don't be concerned about how your payments will reflect in the future beyond the 5-year, because as I say, we will look to put you on a different product based upon the market at the time. So to give you an indication, over the 300 months, which is the 5-year product, at 2.54%, the monthly payment will be £630.89. It does express that once the variable rate kicks in for the remainder of the mortgage, of course, because it's over 25 years, it will be £704.89. That is unlikely to be the case for 2 reasons. Again, we'll remortgage you, or alternatively, the variable rate will likely be different at that time because, of course, the market does change and the offerings do change from lender to lender. So it's important to know your income may change. Please consider whether you're still available and affordable to, meet your monthly installments. It's really important you keep your payments up to date to prevent your credit being effective as well. Now, obligations, I think the one that jumps out for me is that you need builder's insurance. As mentioned previously, this loan is secured against the property. So with regards to the property, it needs to be maintained, and the security of the loan is against that property. So of course, as the loan is being reduced and paid off, that security is slightly less for the lender, whereas it's a matter of an obligation. You have to have building insurance in place. Now, I know, Howard, you've mentioned you wanted to have a look yourself, but we will also provide you with a recommendation. Now, Section 8 is about early repayment charge. As mentioned, it's a 5-year product, and what this product does for you, the charge over the 5 years reduces by 1% each year. So if you was to exit a mortgage within year 1, there will be £7,000 early redemption charge, and then it staggers down all the way down to the final year at 1,220. Now, of course, we don't want you to incur any charges for wanting to leave this lender. Of course, for unforeseen circumstances, that sometimes does happen, but the maximum charge you could repay is to the mortgage is that £7,000. So if you've got any feelings around wanting to fix in for less of a period or not have any alternative tie-ins, let's discuss that now and make sure that this recommendation is right for you. But based on your requirements of a 5-year fixed, I feel it's a very good offering because of the staggered reduction in early repayment charge. Now, good news is that there's some flexible features with the policy. You can see that the mortgage is potentially portable. And I say potentially because you've got to meet the terms of the lender with that will be assessed. But if you do look to move house within the 5-year period, there's potential to take that mortgage with you. And another requirement of yours was to be able to overpay on the mortgage. You can overpay by 10% without incurring your early repayment charge throughout the 5-year period. So have a read of that. Any questions, you know where I am. As mentioned, there's a free valuation. That is for the benefit of the lender. If you do want to check out the property and its condition, by means of its structure, etc., then we would encourage you to choose either a home buyer's report or a building survey. If that's something you would like to look into, then please do request that from myself, and I can recommend a company that can do that for you and make a recommendation based on costs and on their requirements. Now, to let you know, you do have rights as a borrower. You've got 7 days after you've been given a binding mortgage offer to reflect on the loan itself. And of course, in the event of any unlikely event, shall we say, of any complaints, as I said in my initial appointment, you can do that direct to the network Primus via phone, writing or email. Of course, the maximum time for handling the complaint is 8 weeks. If you do not resolve the complaint to your satisfaction, then of course you can take that to the financial ombudsman as well. And the details are in the illustration for you here. Okay, so it's really important that you maintain the regular payments. We talked about that for credit reasons, and also to make sure that mortgage is being paid off and meeting the commitment that you've taken out. You've got to maintain the property, make sure it's kept in a good state of repair, and also take out and maintain builder's insurance as previously mentioned. Now, I'm going to come right down here now and show you the final bit of the illustration. This is your payment schedule. The initial part of the column here is showing the first 5 years. So the end column is the remaining balance. And of course, the fixed period, as you can see, is within the 2.54 throughout. So as you come down, you'll see beyond 5 years, it hits a variable rate. Again, that's very unlikely because we'll look to do a product transfer or a remortgage, or of course, assess your circumstances with regards to what you want to do in the future. But it's a nice little guide for you on the illustration to be able to kind of see where you will be at throughout. Now, I'm going to jump to the protection recommendation. So we just talked about the mortgage that's been taken out. Howard is a single guy, and he wants to ensure he's got security that, if he's not working, especially long term, that the mortgage is cleared. So we've put together a recommendation with AIG. Why have we done AIG? Done AIG based on the critical illness benefits, the enhanced critical illness cover, and the smart health feature that they offer. There's many different providers on our panel that could be right for Howard. As an advisor, I get to choose. And on this occasion, I'm picking AIG. So just to run through the illustration, it's a summary and been prepared for Howard Whale by myself at Fortune Financial on the 16th of March. There's the reference number for the client if it is required. But of course, we just want to double check his details to make sure they are correct. Now, this is a multi-policy, so it's got multiple plans within the recommendation. And the first policy is a life or earlier critical illness plan. Now, the reason I'm recommending life or earlier critical illness and not just critical illness standalone is because the premium is very similar from a matter of pence. And if he was to pass away within 14 days from a critical illness, the policy wouldn't pay out. So I feel it's much more of a benefit to take life or earlier critical illness, because as his circumstances change in the future, it may be that an element of life cover is required, and to automatically add that within, I feel it's much more beneficial. So that policy is covering the mortgage debt, not the value of the property. It's the debt that needs paying off. It's 140,000 over 25 years, and the premium on that is £30.52. Now you can see that some additional add-ons have enhanced the critical illness cover to its maximum potential, which is £7.46. And we've included waiver premium at 50p and total permanent disability at 40p. I'm going to come on to that in a second. Now the additional plan over and above for Howard is an income protection policy. This ensures that beyond the 3 months that his employer would, I suppose, pay his sick pay, he would receive a monthly benefit of £1,600, which we felt would be substantial enough to pay the mortgage, his utilities, and continue his lifestyle until he can hopefully return to work, or until retirement, which you can see is 68. Now, this policy will go into more detail with regards to its offering on page 2 of the illustration. Also, you can see I mentioned Smart Health. There's a health and wellbeing service for no extra costs included with AIG. And of course, we can go into detail with the client on that to let him know that it includes these features as a little bit of an incentive to use that provider as well. So the summary of the quote, as mentioned, it's for Howard. He's an accountant. And the reason that's important is due to the waiver of premium and total permanent disability. Now, the waiver of premium is an insurance within the insurance to ensure that if he can't work, the policy would be paid for him. So he doesn't need to use the benefit of his income protection plan to cover this. Now, the cover for the initial policy is life and critical illness cover. The additional plan is income protection, and the critical illness policy is for £140,000 over the mortgage term of 25 years. The income protection is £1,600 per month. The important thing to know is that the mortgage protection is on a decreasing basis. He has a repayment mortgage, so the policy will fall at a rate of 6%. If the rate is above his mortgage rate, which it will be at 2.54%, it will always be in credit and always have enough left over to clear the debt in the event of a critical illness. Also, with the income protection, I've included indexation. That's an increasing policy based on inflation. Of course, the cost of living at the moment, especially, is going up and up. So he will receive an annual review from AIG, giving the option to increase based on the retail price index in the future. Now, really important, the income protection policy is a full payment term. It doesn't pay out for 2, 3, 5 years or 10 years. It pays out if he's off work as of today for accident, sickness and disability, all the way through to his retirement age if he cannot return to work. Now, just to touch on the waiver of premium, we have included that. It's automatically included for the income protection at no extra cost. And again, that ensures that the policy is paid if he's unable to work beyond a deferment period of 13 weeks, which actually works very well as he receives full sick pay for 3 months. And finally, he receives total permanent disability based on his own occupation. If he's registered disabled and he's unable to do his own occupation, it will be classed as a critical illness and it will pay out and clear the mortgage debt for him. So immediate cover is available from the date of fully completed application. It's submitted to the provider. So what we need to do now is we need to move forward and obtain terms for the client. Of course, we're going to express on the cost of the policy itself at £30.52 and £30.09 per month. This policy does come with a plan discount, which I'm just going to jump back up to the first page for you and show you that there's a plan discount here of £2 per month, which doesn't sound a lot, but £2 per month, £24 a year over potentially 25 years, for example, can add up to be a lot of money. So I'd always express that to the client. So the policies are underwritten, they're medically underwritten. They're based on the client's height and weight, his health, his occupation, lifestyle, and financial requirements. So it just talks a little bit about that here. The important thing to know is that this is a quotation. It's not terms offered. So of course, we need to complete an electronic application on the client's behalf, of course, with your consent due to data protection, to provide that information to the provider, and then we will receive terms. The terms you could potentially be offered are standard rates based on what we've discussed today. You may be offered non-standard rates if your medical circumstances were significant. As we can see with Howard from his case study, he hasn't got any medical complications, so it's unlikely it will be postponed, declined, there'd be no doctor's report required, and there'd be no nurse screening required to obtain the terms. Basically, what I'm getting at is this guy can get cover immediately. So, Mr. Client, this is available for you, and I'd be confident saying that. Now, the quote is valid up until the 15th of April. Of course, if we did go beyond that for the point of application, the premiums may change. And just finally, at the back of the illustration, there's some information on commission and how that is paid to ourselves and Primus. We get paid from the provider for doing a job on their behalf for the client. The clients do not pay us anything for arranging the protection, including any trusts and wills with Fortune Financial. So there's your illustration. That's how you'd recommend that to a customer. When you're doing your role play on Zoom, I'd encourage you to share screen, use it, read it, tee yourself up in the right way, and don't be concerned that you need to kind of slow things down and speed things up. Do it at your own pace. And if you feel you need to ask questions to your ASM, especially as a non-CAS advisor, then ask the questions and get the support. It's not being judged and assessed. They're here to support and guide you and make sure we can get you through to competency. Now, the final step with regards to the sales process is the key feature document. Now, when you make a recommendation, such as that illustration for the client, there was two elements to the plan: income protection and mortgage protection as life and critical illness. So you would issue this to the customer. Now, this is really important. One thing you will not do is you will not go through this word for word and talk about the policy ins and outs. Every provider is different. The clients would switch off. So what is important is to touch on the key elements of the policy. Now, we've put something together to enable you to remember this, and this is called ARCTIC. Now, ARCTIC is ARCETICC, and each letter stands for an area we should really discuss when touching on the key feature policy. So when I'm presenting this to a customer, I would first turn around and say it's important for them to take the time to read it in your own time. And of course, if they've got any questions, come back and we'll get them answered for you. But we'll start with ARCTIC. So A is aims. What is the aim of the policy? The aim of this policy is to protect the mortgage debt and give you security should you have a critical illness. The aim of this policy is to replace your income if you're unable to work due to an accident or sickness or disability beyond your employer benefit. Now, risks. What are the risks? The risks are that if you've not been as open and honest with regards to your medical situation and lifestyle, then the policy could be underwritten incorrectly, meaning non-disclosure would happen and the policy would not pay out. So it's really important that you are clear and open and honest with us so that once we get the terms offered, you've got confidence that the policy is going to do the job it's supposed to do for you. Now, C is commitment. The client has a commitment. You, client, Mr. Client, have a commitment to pay your monthly premiums, maintain your monthly premiums month in, month out throughout the years of the plan to ensure that the policy remains in force. Now, ARCTIC has got an E in the middle, exclusions. Exclusions with life insurance tends to be, sadly, suicide. Where it is done through self-harm, policies may well exclude. ARCTIC then comes on to T, which is taxation. And good news is for the client is that the policies are paid free of any income tax. There may be other taxes that are involved. I must express I'm not a tax advisor, but what I can do for you is we can offer a trust against the life and critical illness policy to mitigate your liability of inheritance tax. Now, because it's a critical illness plan, we're going to touch on illnesses. We're just going to mention for the compliant process 3, cancer, stroke, and heart attack. As you can see within these policies, there's many different conditions that could be covered for the clients. We're not a doctor, we're not a GP. We're not going to go through each and every one with the customer. We're going to express that, the policy is enhanced. It's got many conditions that are covered, but the main 3 are cancer, stroke, and a heart attack. Now, the last two elements of the policy that we're going to come to, and again, we don't need to go through the document and the booklet with the client, is going to be claims. Now, it's important to know that if they do need to make a claim, they can go to AIG direct themselves, and they can do it through three ways that the information is in the booklet. It can be via phone, it can be via email, it can be in writing. A claim can be done direct to AIG, as I say, but also you're their advisor, so be there to look after them and give them the service they would expect. So I'd encourage you to say to the client, if you do need to make a claim, come to me and we'll fully help you. Fortune Financial and you as the advisor here to support with AIG. And the final step within the recommendation for the key features is cancellation. Now, you've got an obligation and a commitment, as mentioned, to maintain your monthly premiums. But if you do change your mind, and you change your mind within the first 30 days, any premiums you would have paid will be refunded back to you. If you decide to cancel the policy in the future, 6 months, 12 months, years down the line, any premiums paid will not be refunded because, of course, the insurer has been offering you that element of security and protection. So that's the end of the key feature. You've finalized the sales process by ensuring the client is happy with the recommendation. And then we would express that the advice that's been given today will now be sent to you in two formats. For a mortgage, it will be a suitability letter. And alternatively, for protection, it will be a demands and needs letter. Now, this is generated through the toolbox system, and it will be sent pre-application from your case manager. So this is not something as an advisor within Fortune Financial you need to control yourself. Now, of course, as mentioned again, you need to ensure the client is happy. Do they fully understand the recommendation? And is there any questions they may have? If they're happy to proceed, you will then move forward with the electronic applications to make sure the client can proceed to the mortgage offer and the terms offered on the protection. Thank you for watching today. Hopefully that has been educational for you. If you do have any questions, I'm here to help. If you do have any questions from a compliant perspective, your ASM is there to help. And I'll express that once again. They're not here to judge. They're not here to assess. They're here to help and guide and support you into becoming an amazing advisor within Fortune Financial and Primus. So thank you for your time. I will see you soon.